Hello, everyone. Raj Malhotra here again, ITPM Senior Trading Mentor. So one thing I want to point out is no matter how the economy is doing and no matter how strong the stock market seems, there are always companies that are struggling and possibly can be zeros. You'll see it in retail. You'll see it in flawed business models. A lot of times these companies go to zero and it has nothing to do with the economy. In fact, so that's the part of the exercise as a good trader is to look for business models that are flawed and are probably going to zero just because of bad management, bad concept, bad ideas, whatever. So today, I'm going to highlight one company that I think is toast. This company is called Bumble. BMBL is the ticker. Now, I strongly believe that this stock could go to zero by the end of the year. I also believe that there is a much higher percentage chance than the market is currently pricing in, even though the stock has been under pressure tremendously in the last year or so. The market's probably pricing right now less than a 1% chance, but I'm estimating that it probably is something around a 20% chance, which is big enough for a tail risk trade right here, especially if you're just looking for some short exposure. Now, the biggest flaw in the company's balance sheet is if you look at this right here, the company is accounting for $3.6 billion of assets, but 3.2 of that of those assets are goodwill, and other intangibles, and they've got $100 million of accounts receivable. So keep in mind that business model just doesn't work. I have no idea what this goodwill or intangibles are, but I'm pretty sure swiping left and right doesn't work as goodwill or intangibles. And with just the accounts receivables to just over $100 million, this company's probably on its last legs. So going back to the business model of this company, this was a company all about female empowerment, and this concept has failed miserably. If you look back here in May, what the company did was they started allowing men to approach women on the app because all of the men left the app. Originally, the business model was that only women could approach men, and that just didn't work. So basically, what the CEO and the company have admitted is the entire business model is a failure. And secondly, it now invalidates the entire reason why women were on the app in the first place, besides to meet me, of course. So right now, there is no reason for men or women to be on this app. So you figure out how that works. If you look at the dating app universe, Tinder is for hookups. I've learned that from my past. Hinge is for serious relationships, apparently. And then there's Grindr for homosexuals. And there are plenty of other match brands that Bumble just can't compete with anymore. So it's pretty likely that Bumble subscriptions are likely to plummet almost to zero. So therefore, that goodwill and other intangibles are completely worthless and are just made up numbers. So look here at the liability section of the balance sheet. So the liabilities are close to 1.3 billion. 628 million of it's debt, and 408 million of it are other miscellaneous long-term liabilities. So even if we give them the benefit of the doubt on their accounts receivable on the asset side of the balance sheet and strip out goodwill and other intangibles, which we know are worthless, they've got about 600 million of assets. They've got about 1.3 billion of liabilities. So the company's net worth is almost negative $700 million. But right now, if you look where the stock's trading, the market cap is around $1.2 billion. It was higher when I put it on, but it still works pretty well here. So if that valuation, it's something trading around 13 times forward earnings and 1.4 times forward revenue for an actual joke of a business at this point. So let's look at the chart here. As you can see, it's gotten pummeled. Stock was above 80 bucks at one point. Stock's trading just above $9 here. But just because a stock is down, whatever it's down here, almost around 90%. Remember, any stock at any point can go down 100%. If you go from 80% to zero, that's down 100%. If you go from $9 to zero, that's 100%. So what you want to do is set up some tail trades here, and you want to buy some out of the money options in case this thing really does go to zero, and you get a really, really big asymmetric payoff. So look here at the charts. I'm looking out to October and January of 2025, a little further than I usually look out. But again, this is when we're playing for tail trades. You often want to look for maturities that are longer than the normal 20 to 60 day time period that most of the trades that we put on the institute are. So let's look at the payoffs here on this chart here. So let's assume that you have $5,000 to spend on tail risk in a $100,000 trading portfolio or more. Let's say you do that. If you want to buy the October 7 strike puts, they cost about 30 cents. With that, you can buy 166 of them for a spend of just under $5,000. And let's just say the stock goes to 5 from where we are now by October. You will make $1.70 per option, or a little over $28,000 on this trade, and about a 567% return, or a 5.67 to 1 return, which obviously everybody would be pretty happy with. Let's say the stock goes even further. Let's say this starts accelerating. So instead of going from, let's say the stock goes all the way down to $2.50 by October expiration. Again, you had the same spend and the same number of options. For that $5,000 spend, you'd make $4.20 per option, or almost a total of $70,000, just under that. Basically, a 1,400% return. And let's say it went all the way down to zero. Let's say that your thesis was 100% right, and it went all the way down to zero and it's bankrupt by October expiration. For that same spend, you make around $111,000, or a 2,233% return. Obviously, a complete home run. So don't swipe left on this trade idea. Let's say you looked out to January of 2025, and you wanted to buy even deeper out of the money options because you really, really wanted to play it to zero. In this case, you would buy the very cheap options. You could pay 10 cents for the January 4 strike puts. Again, deep tail trade. With that, you can buy 500 contracts with a $5,000 spend. So with that $5,000 spend, let's say the stock just went to $3, just $1 below your strike. You'd still make a 900% return, or $45,000 on that trade. Let's say the stock went to $2 from where we are now. With those 4 strike puts, again, you'd pay 10 cents and you buy 500 of those. You would make $95,000, or a 1,900% return. And finally, let's just say it went all the way to zero. You are completely right on this thesis. This women empowerment business model is flawed. Let's say the stock went all the way to zero. With that $5,000 spend, you'd make $195,000, a 3,900% return, in a complete home run of a trade, and a trade that you would probably be one of the highlights of your P&L. Now, again, I'm not saying this is 100% going to happen. I'm not saying that it definitely will happen. But the point is, you should always be looking for tail trades in your portfolio. And you should always be looking for trades in businesses that are set up to fail. They are a little hard to find. They do take some time to identify. But remember, just because a stock is down a lot from its high doesn't mean it can't go to zero, especially if the business model is completely flawed. So with that, look for some tail trades, look for some home runs, and let's swipe some positive P&L. Take care, everybody. I'll see you guys on the other side.